Ever wondered how the truly rich actually invest their money? I mean, we all hear the standard advice, right? Just buy an S&P 500 fund and call it a day. Well, in this explainer, we're going to go way beyond that. We're pulling back the curtain on the strategies used by the ultra-wealthy and these massive institutions that manage literally trillions of dollars. Let's get into how they really do it.
And you know, it all starts with a question as simple and as real as this one from Reddit. It's a question a lot of us have probably kicked around in our heads. How does it actually work at the very top? What are they doing that the rest of us aren't? Well, let's find out.
All right, here's our game plan. First, we'll see why it's a completely different ballgame. Then, we'll go beyond the stock market, dive into the world of alternatives, uncover the massive role taxes play, look at how the giant institutions do it, and then we'll wrap it all up with the real takeaway.
Okay, let's dive right in. The single biggest difference isn't about picking this hot stock over that one. No. It's about the entire approach, the whole philosophy. It is a fundamentally different way of thinking about a portfolio.
And here it is. This is the great divide. A regular investor, maybe someone like you or me, probably has almost everything, like 95% in public stocks and bonds, stuff you can buy on an app. But the ultra-wealthy, they're playing a different game. They might have up to half of their money in private investments. These are things you just can't get on the open market, and they come with a totally different set of rules.
I love this quote from Reddit because it just nails the mindset. Think about it. A lot of people get rich by concentrating their bets, like a founder who owns a huge chunk of their own company. But once you've made the money, the game shifts. It's not about getting more. It's about keeping what you have. It's about preservation. And that's where their kind of diversification comes in. It's not just different stocks, it's entirely different kinds of assets.
So if it's not just buying stocks on the public market, what is it? Well, what's fascinating is that there isn't just one secret playbook. The pros actually use a few different, well-established models, and each one has its own philosophy.
You can really break it down into these three main approaches. You've got the Norway model, which is kind of like the index fund strategy on steroids, super low cost, passive investing in public stuff. Then there's the endowment model, made famous by places like Yale, that goes all in on those alternative investments. And finally, the Canada model. They love alternatives too, but they're so into it, they build their own teams of experts to manage everything directly. Okay, so I've said this word alternatives a few times now, and it's pretty much the key to this whole thing. It's what makes these wealthy portfolios so different. So what the heck are they really? Let's break it down.
The definition is actually super simple. An alternative is basically everything else. If it's not a stock, not a bond, not cash sitting in a bank account, it's probably an alternative. But here's the key thing to remember. They're usually less liquid. That means you can't just click a button and sell them tomorrow, and they operate with a different set of rules.
And alternatives isn't just one category. It's this huge universe of stuff. It includes financial things like private equity and hedge funds, sure, but it also includes real, tangible things you could go out and touch, like apartment buildings, airports, toll roads, oil pipelines, you name it.
And look how much they actually use them. This is the average for big university endowments, the ones with over $1 billion to manage. A staggering 57% of their money is in alternatives. That's the endowment model in action. It completely flips that old 60-40 stocks and bonds portfolio right on its head.
All right, so we've talked about what they buy, but there's another piece of the puzzle that's just as crucial, maybe even more so, and that's how they make sure they lose as little as possible to taxes. This is a huge, often invisible part of their strategy.
So let me just ask a simple question. If you make $1 selling a stock you owned for 6 months, is that dollar taxed the same as one from a stock you owned for 2 years? The answer is a huge, resounding no. And that difference? Well, that changes everything. Here's the simple version. If you sell something in under a year, that profit gets hit with the same high tax rate as your paycheck. But, and this is a big but, if you just hold on to it for more than a year, it becomes a long-term gain, and suddenly the tax rate gets slashed, sometimes by almost half. That simple rule creates a massive incentive to think and invest for the long haul.
And holding for the long term is just scratching the surface.
There's a whole toolbox of other strategies, things like tax loss harvesting to offset gains or using special accounts for charitable giving. Every single one is a legal tool designed to do one thing: keep more money invested and compounding instead of just handing it over to the taxman.
Okay, so we've seen how wealthy individuals operate. Now let's zoom out, way out. Let's talk about the absolute giants in the investment world, the institutions. We're talking pensions, sovereign wealth funds, university endowments.
The scale here it's just mind-boggling. Globally, these institutions manage an estimated $70 trillion. That's not just money, that's a force of nature that moves entire markets. And when you're working at that scale, you have a completely different set of problems and responsibilities.
A perfect example is pensions. There are basically two kinds. You've got the old-school defined benefit plan, where the company guarantees you a certain payout for life. The company's on the hook, so they bear all the risk. Then there's the defined contribution plan. That's like your 401k, where you take on the risk. You can immediately see how the people running that first type have to be way more focused on not losing money.
This all leads to a strategy called liability-driven investing. It sounds fancy, but the idea is simple. For these giants, the number one goal isn't always to hit home runs. It's to make sure that for every dollar they've promised to pay out in the future, they have an asset to cover it. They're constantly solving this incredibly complex math problem that stretches out for decades.
So after looking at all these pieces, the private markets, the tax strategies, the institutional models, what's the real big picture takeaway here? What does this all really mean?
It really all boils down to these four things. First is access. With enough money, you just get to play in a different sandbox that's close to most people. Second, the objective changes. The focus shifts from the mad dash of accumulation to the careful, deliberate strategy of preservation. Third, the time horizon. They're not thinking about next quarter. They are literally planning for their grandkids. And finally, scale. The sheer amount of money changes the rules of the game.
And this quote just brings it all home, doesn't it? We started this whole thing asking how rich people invest, which is really a question about accumulation. But what we've learned is that once you have the wealth, the far more important and far more difficult question is about preservation. So maybe the ultimate secret we've uncovered today isn't just about how you get rich, it's about how you stay rich.